Joe, really happy to have you here. Let's welcome Joe.
Thank you, really appreciate it. Can you hear me? Yes. All right, good. Well, thank you for hosting today. This is, I was just saying to Jeff beforehand, as he just laid out, my colleagues and I who follow economic conditions tend to break things up by sector. And so some really key areas of focus for me here today, because I follow manufacturing and agriculture most closely. And we have a lot of folks in the room that are at the intersection of those two things. And construction, obviously, pretty vital as well. And so really happy to have the opportunity to connect with this audience today. A couple things just to get out of the way before I get going. Standard disclaimer our lawyers like us to give. If I say anything dumb, it's my fault and not the Fed's. And in particular, I'm going to talk. I'm not going to spend a lot of time talking about the Federal Reserve, but I'll talk a little bit just to give you some basic background. One important thing you need to know about the Federal Reserve: despite the name federal, we're not actually a government agency. We are created by Congress, but we have some independence from the government. We're essentially a nonprofit corporation, and we're kind of similar to the post office or to Amtrak in as much as we are created by the government, but we have some independence. We basically provide our own funding. And in order to do a good job with what we've been tasked at, it's important to stay kind of a little bit isolated from the political process. So we kind of try and stay out of the political process. That doesn't mean that I don't have my own opinions, but they're just mine. And I'm going to try not to express my opinions today anyway, because why should you care what my opinions are? So I'm going to try and keep things mostly fact-based and not veer into that kind of too much. So I'm going to give you a little bit of background on the Fed just to kind of tee up. Why is there a Minneapolis Fed? What do we do? And then I'm going to get into the sort of economic update. And a lot of times, so I'm a regional economist. My focus is really on this part of the country and on some of those industries that I mentioned already. But lately, obviously with everything going on with inflation and the Fed ramping up interest rates, I think that's what a lot of people are interested in hearing about. So a lot of what I'm going to be talking about is going to be kind of more just sort of by nature of it, national. But I will have some regional information to share as well. But a lot of that, when you're talking about inflation, fundamentally that's the value of the dollar, and that's going to be national or even international kind of context. So I hope that's still of interest to you. I'll talk about kind of what we see about why inflation has gotten so high. Maybe some positive news about the direction that's heading and what the Fed's doing about it. And throughout, I'm hoping you're willing to participate. I'd like to kind of tap your expertise and do some live audience polling. So typically, if I do see people pulling out their cell phones while I'm speaking, it's usually not a good thing. But I'm actually going to want you to have those at the ready if you don't mind, if you're interested in participating. I am going to want to try and gauge your views on how business is going for you. I know we got a lot of business owners, senior leaders in the room today. And so what I'm going to have you do, I'll be peppering some questions kind of throughout the presentation as I go through my content. So I'm going to want you to get out your phone and get into the text mode and just send a text to the number 22333 and just text the word Minneapolis. That's just no upper lowercase, doesn't matter. Text that word. You should get a confirmation after you hit send. And then just kind of keep your phone out, because I'm going to pop into some of these polling slides. And the way you're going to do that is you're just going to, I'm going to put up a question, and you're just going to respond to that question with a multiple choice A through whatever letter I happen to go through for that particular question. So that's kind of how we're going to do that. I'll leave that up for just a second if anybody still needs to catch up on that. I'm really hoping, usually I like to do this. I think it should be interesting to people in the room to see what your peers are thinking in terms of recent business conditions, hiring. I'm going to ask you a little bit about how the hiring environment is going right now, the labor market. I'll talk a little bit about why we're so interested in that in a minute. And then what you're seeing in terms of inflationary pressures in your outlook right now. I hope that's going to be interesting for you to see what your colleagues are thinking, and it's really interesting to us at the Fed. This is a way for us to get kind of real-time economic intelligence from people who know. So let me get you a little bit of just kind of quick briefing on what the Fed is. So I mentioned we're not actually a government agency. What makes us federal is that we are federally structured. So when they created the Fed's America's central bank, when they created the Fed 100 years ago, you might remember from your American history textbook, there was Alexander Hamilton created the Bank of the United States. Was not a really very popular idea. Hamilton had to argue really forcefully for it. Its charter expired, and he had gotten shot in a duel and wasn't around to continue arguing for why we should have to have a central bank. Then we had the War of 1812, and Congress realized we needed to have a central bank to help finance that war effort, and so they created the second bank of the United States. And then you had Andrew Jackson, was really strong opponent of that, campaigned for president on a promise to abolish that bank, and they did. So we have a long history in this country of distrusting concentrations of financial power, and for good reasons. So when they created the central bank, the Federal Reserve, to be the central bank, to be a lender of last resort in times of financial emergency, which we've been kind of reliving a little bit of recently with Silicon Valley Bank and some of those kind of incidents, they wanted to make sure that the power was decentralized and that they weren't just making decisions based on what was happening on Wall Street or what the interests of people were in Washington. So they carved up the country into 12 Federal Reserve districts, and you can kind of see the map of them. System was designed 100 years ago, so they're pretty heavily concentrated on the East Coast. But you can see here in Minneapolis, we're responsible sort of for the north central United States. Just a quick bit of, actually, one thing I should have said, I mentioned SVB and some of the banking turmoil that's going on right now. One thing I should have said at the outset, first of all, please interrupt me with questions. If I say something that doesn't make sense or that you disagree with or you'd like me to say something more about, would love it if we could do questions throughout. For people who are tuning in online, I'll repeat the questions so you can hear them. I do have a lot of slides, and I want to get through them, but if I don't get through them, I don't think that's a problem because I'd much rather have kind of a dialogue and be responsive to the things that you want to know rather than just yak at you for an hour. So please do feel free to jump in at any point with questions and like I said, about anything that I say or just general questions you have about the Fed, economy, and things of that nature. So what do we actually do at the Fed? Well, I said we're a central bank. We were created originally to be kind of a lender of last resort in times of financial emergency. We're also a bank. We're a bank for other banks. So that's the reserve part of our name. Banks keep their reserve accounts at the Fed. We provide financial services. So most of you probably do your payrolls through ACH, the automated clearinghouse. That's an infrastructure we run. So we provide some of the rails on which what we call the payment system operates. We also maintain the nation's supply of coin and currency. So we have a big vault at the Minneapolis Fed full of cash. And if you're ever interested in coming down and checking it out, you can go to our website, minneapolisfed.org, and find out how to take a tour. I would highly encourage that. Because we have the authority to lend to banks when they get into trouble and other financial institutions, we also have regulatory authority over them to try and keep them out of trouble in the first place. So we have supervisory regulatory powers, not over all banks, only really over the largest national banks, those that do business in multiple states, bank holding companies, those are entities that own controlling interest in one or more banks, and some other institutions like that. That's about all I'm going to have to say about bank regulation, I promise. I'm not a regulator. If you do have questions, happy to try and answer those for you. But my job actually relates to the thing that we're maybe best known for at the Fed, which is monetary policy. That's when you hear about the Fed raising and lowering interest rates. Monetary policy is kind of one of the two key levers of national economic policy. That's the influence of the supply of money and credit in the economy. And we make those decisions at the Fed with two goals in mind. And this is per federal law. So Act of Congress stipulates that we need to make monetary policy so as to support maximum employment and price stability. We want to make sure the labor market's functioning, the economy's growing in such a way that everybody who wants to work, who's able to work, can find a job, can find gainful employment, and that the dollar is maintaining its value, that we have low inflation. So we interpret that as low unemployment, low inflation. And most of the rest of my talk, I'm going to talk about how well or poorly we're doing with regard to those two, particularly the inflation picture. So that's kind of the context behind a lot of the rest of the data that I'll be going through. Is that's what we really keep laser focused on are those two things, the job market and prices. So now I'm going to have you, before I get into the kind of overall economic picture, I'm going to poll you real quick. And you can see the options up here where you got the A through F. I just want you to think about at your own business. I'm using the term recent, which is a little bit ambiguous, but I want you to think about maybe the most recent quarter or even the most recent few weeks since the end of Q1. Just think about what's happening with recent sales or orders at your business. And you can see the options here going from very poor to very strong, A through F. I'm not going to bother reading them all off because I'm assuming everyone can see the slides okay. Can we all see the slides okay? Good. All right. So I'm going to let those fill in for a second before I get into talking about kind of the overall picture. Why is this interesting? Well, I hope it's probably obvious why it's interesting. One of the reasons I want to start with this question, though, is because there's a lot of speculation right now about whether we as a country are in a recession or heading into a recession right now. Now, I'm not going to give you too robust of a prediction about that, partly because I don't really know, and that's why I'm asking the question, but also because economic forecasting is very much an art rather than a science. I do a little bit of economic forecasting in my job. I like to say that economists got into the business of forecasting because we felt bad for weather people. Really, some of the best data that we have available to us are the kind of information that you can share with me. So we look at the data, and that's what I'll be walking you through, some of the data that we have on this, but really some of the best insights we have, because the data tell us about what's happening in the past, what's already been happening. So getting information from businesses around our region is really how we kind of try and get out ahead of the data. And it looks like, on balance, things are still looking pretty good for you. Nobody picked A, which is nice to see. A few of you seeing some recent declines. Mostly folks telling me that things are steady and doing okay, which is nice to see. I'm not going to ask you how you think other businesses are doing. So let me get into this question of kind of are we experiencing a recession right now? There have been predictions about a recession for the last year or so, ever since the Fed started cranking up interest rates, and yet somehow the economy stubbornly refuses to go into a recession, or at least by the way we typically measure it. Now I'm going to point out something real quick. So this is GDP. So I'm showing you the quarterly change in gross domestic product. That's our best measure of the value of goods and services that the economy produces. Early in 2022, we saw 2 quarters of falling GDP, of negative GDP growth. And a lot of times, so there was a lot of speculation about a recession at that time, because that's a rule of thumb that a lot of people use for whether we're in a recession. It's not the technical definition of a recession. I'm not going to belabor what the technical definition is. But the National Bureau of Economic Research's Business Cycle Dating Committee has a number of different data sources they look at. And generally speaking, what they're looking for is not just falling GDP, not just falling output, but for it to fall across multiple sectors, not just to be concentrated in one area, and for it to be sustained for a period of time. So we saw kind of a couple quarters of weak GDP, and then we've seen positive growth since then. We just got our first estimate of Q1 2023 GDP, and that was low but positive. Breaking it down by kind of category, you can see that, as I just mentioned, when you see it, what you really want to see in order to make a call about whether there's a recession is most things falling at the same time. Now, I'm not breaking this down by industry, by say manufacturing versus agriculture, but you can see that if you actually look at the composition of how the economy changed, a lot of the decline, or a lot of the weakness in GDP is really heavily concentrated in a couple areas, in particular inventories right here. They make adjustments for inventory accumulation. That came down a lot in Q1. Sometimes we see that happen at the beginning of the year, where you see this kind of moving ahead of inventory accumulation at the end of the year, and so that's correspondingly kind of lower inventory growth at the beginning of the year. And then net exports. So we saw net imports increase in the first quarter, and that's a drag on GDP. But across most categories, still positive growth. By the way, over the last year when we had weaker GDP coming in, a lot of that was concentrated in housing investment, and that's what you expect to see happening when the Fed's raising interest rates. That's the first thing that gets affected by tightening monetary policy. We're making it harder to take a loan to build or to renovate houses, and that's actually sort of the intent, is that tightening interest rates brings down inflation by working through the demand side of the economy, and that's the first thing that gets affected. So that's kind of the overall picture of what the economy is still operating at a positive clip. I'm not necessarily making a prediction that we're not going to go into a recession, but the sort of cottage industry of professionals who forecast the economic outlook keep kind of pushing that window for when we expect there to be a recession further out. So right now, the kind of consensus, if you look at some of these publications like Blue Chip, is, that's a weird one. Okay, let's try that again. All right, this may or may not work for me. That's fine. So if you look at some of these publications like Blue Chip Economic Indicators, the consensus forecast among economic forecasting professionals, I'm just going to skip that slide, is that we're expecting a recession to begin later in 2023 and for it to be a relatively shallow recession. But again, as I mentioned, as time goes on and the data keep coming in pretty strong, those forecasts keep changing. So, and by the way, that's not my forecast. I'm just kind of characterizing what we're seeing from the sort of professional economic forecasters. So as you can see, I've got this question up here. I'm about to get into the sort of labor side of the picture. It's not news to us that most folks are the labor market's been really tight for a long time, and just kind of wondering what you all are seeing in terms of your ability to fill open positions right now since the beginning of the year. Kind of interesting. It looks like a good chunk of you so far saying that things have gotten a little bit better. That's maybe consistent with what we again expect to probably happen. And by the way, when you look at the data, even though, as I'll show you in a moment, employment growth has still been really strong, unemployment is still really low, the data that we have available to us on the number of job openings economy-wide, those have been coming down. So that's kind of like the first margin that you expect to adjust in a tightening monetary environment is sort of some of those open positions getting, if not filled, eliminated before we start to see big change in employment. And hopefully we get inflation more under control before we start to actually see really negative direction in employment. So it looks like most of you, only a few of you here saying things have gotten a little worse, more of you saying they've gotten better, which is nice to see. So that's, like I said, that's good news in a way because we know that for a long time, and certainly in a very much more acute way since the end of the pandemic, we've been experiencing a very tight labor market, both nationally and in our region, in Minnesota, and in some of the surrounding states. This has been an endemic problem for a long time. The pandemic was this kind of big shock that happened in the middle of it. But before the pandemic, this was the thing I was talking about most to audiences, was this kind of long-term, tight labor market environment. What are the structural factors behind that? And that was the thing we were really focused on. So I'm going to share some indicators of the labor market with you right now. Like I said, right now the economy is still adding a lot of jobs. We see that reflected in a lower rate of unemployment. In fact, we have the lowest rate of unemployment nationwide in more than 50 years. Haven't seen, we're down at around 3.5%. Haven't seen that rate of sustained, an unemployment rate sustained at that level since the late 60s. So even going back to the early 2000s when we had that really strong late 90s era job market, we still didn't see unemployment get down this low. Now, unemployment is an imperfect measure of the labor market. So if you're not familiar with what these stats really mean and how they're calculated, the Bureau of Labor Statistics that releases these numbers, they do a couple of monthly surveys. They're released on the first Friday of every month. So we just recently got our numbers for April of 2023. We don't have them for Minnesota yet. So you can see Minnesota, I've gotten the kind of gold line here just to compare. Minnesota's unemployment rate tends to be lower than the national unemployment rate. But the way they calculate these statistics is they call people's houses up at random, and they ask them, are you working? If you tell them yes, obviously you're counted as employed. If you tell them no, then they ask you, are you looking for work? Are you trying to find a job? And they ask a bunch of other questions too, your demographics, whether or not you're working part-time but would like to be working full-time. So there are these broader measures of unemployment, but the headline rate of unemployment that you usually see at the beginning of the month when these statistics are released is basically just that ratio of people who are out of work but looking for work. It's an attempt to measure how much slack there is in the labor market. Now, obviously, there's some shortcomings to this. One of the important things they're missing in this statistic is the number of people who are retired, full-time students, otherwise not in the labor market. It's also importantly not including people who've decided to pull out, to quit looking for a job because they haven't been able to find one, they're discouraged, right? Now, a lot of times you'll hear people say, well, the unemployment rate came down, but that's because there's fewer people working. They're pulling out of the labor market. That's actually not true right now. Right now, actually, the declines in unemployment we've been seeing, when you dive into the numbers a little bit further, they're primarily driven by actual growth in employment, by people taking jobs, and the number of people, the percentage of people who are not in the labor force has been falling. So we've actually seen, while employment has been increasing, we've actually been seeing the labor force increase over recent months. So in our most recent reading, April 2023, we saw growth of about 260,000 jobs nationwide. Historically speaking, that's pretty strong. I'm sorry, that was the month before. It was about 220 plus thousand jobs in April. Again, historically speaking, pretty strong. A lot of charts of economic data, if you look at over the last few years, look something like this. They fall off of a cliff in March and April of 2020. And by historical standards, this is actually a really quick recovery. So getting back into what these data are actually reporting to you, I told you about the unemployment rate that I just showed you just now. The employment numbers come from a different survey. That's a survey that the Bureau of Labor Statistics does of businesses. They call up businesses and ask how many people are on their payrolls, and they use that to estimate the net change in the number of people working every month. So that's the employment statistics. And you can see right now we're actually every month we've been hitting a new record in employment. The pre-pandemic peak in February 2020, we got back to that level in August of last year, and now we're back above that level. That's not to say we don't know exactly where we would be had the pandemic never happened, right? We can't run the counterfactual. But if you look at kind of what happened in early 2020, we've never seen employment fall by that much that quickly. In percentage terms, employment fell by more during the Great Depression. It fell by actually 25% from peak to trough during the Great Depression. But it took a lot longer to fall that much. And of course, it took a lot longer to get back, right? Partly because this is just sort of underscores the weird nature of the pandemic. It was a bit of an artificial, a lot of people were temporarily out of work while they were furloughed. So compared to any other historical recession, not only was this a bigger shock, a bigger drop, but the recovery from it was really quick. If you look just by comparison, if you go back to 2007 through 2009 global financial crisis and the Great Recession, it took years to get back to peak employment after the Great Recession. We didn't get back to peak employment until sometime around 2013, 2014. And it was a really slow rate of growth. So this is a pretty fast recovery by any measure. If you look at it in terms of what's the percentage of the population who are working, so this is the employment to population ratio, we're not quite back to the peak that we were at February 2020, but again, that's not like a magic level that's where we should be. In fact, long term, the employment to population ratio has been declining for 20 to 30 years because of the aging population, because of the sort of demographic change in the U.S. A smaller percentage of people over time have been changing. That's been a long run trend. So again, we're less than a percentage point below where we were pre-pandemic in terms of the percentage of the population who are working. So again, just going counter to this idea that the reason it's hard to fill jobs is because there's a lot of people who are sitting on the sidelines. Every month we're seeing more and more people who were on the sidelines coming back off the sideline. Labor force participation is is a related measure. Again, you get basically the same story. So by a lot of different measures, even though we've been raising interest rates, the economy is cooling off. We're continuing to add a lot of jobs, and we're seeing that reflected in wages as well. So I kind of wanted to, I don't know if the options are going to come up for you here. Oh, maybe not. Not sure why this one's not working. Okay, that's goofy. All right. Well, I did want to ask about what was happening with wage growth at your business, whether you've seen it increase or decrease recently. But fortunately, we have data on that too that we can look at. So I'm kind of curious on the more recent perspective from you. And again, if you look at the recent rate of growth in wages, so just a quick explanation of what I'm showing you here. This is the percentage change over the year in average hourly earnings for, when we say production and non-supervisory employees, those are people who are not managers. So you're mostly thinking of these in terms of sort of hourly workers or other people who are not in managerial positions. And I have it across, I'm going to show you it across an array of industries, but the main thing to take away is that the rate of growth since the recovery from the pandemic got underway in 2022 is higher than it was prior to the pandemic. Now, there was this long period after the Great Recession where we were hearing from businesses over and over again that it was their biggest challenge was filling open positions. There weren't enough workers, but we weren't seeing it nationally, at least, reflected in a higher rate of wage growth. which told us there was something else that was going on that wasn't necessarily, because as an economist, you think in terms of supply and demand. When something becomes more scarce or more in demand, you expect the price of it to go up, and we weren't seeing, at least in the aggregate, faster rate of wage growth. That's not true right now. One big qualification I'm going to make here, this is pre-inflation. So I'm going to show you what this looks like after adjusting for inflation in real terms in a minute, and it's not pretty. This is just a variety of other sectors. I'm not going to elaborate on the sector-by-sector differences other than to point out really big spike in leisure and hospitality wages going into 2021. A lot of this is reflecting the change from the pandemic. Obviously, that was the most heavily affected sector during the pandemic. A lot of people who were working in that industry left and took jobs elsewhere, and we were seeing that reflected in a faster rate of growth. And also all the other familiar things that we've experienced in terms of maybe lower quality of service, in terms of businesses not necessarily being able to stay open and fully staffed because of the extreme tightness of workers in those industries, in hotels and in restaurants. So that's kind of a sort of a graphic illustration of that story. So that's kind of the labor market picture. Like I said, we don't, the Fed has a maximum employment mandate. We don't necessarily have a magic number that tells us here's what maximum employment is, because that's probably a moving target. People used to say a 4% rate of unemployment is really kind of the lowest you can get on a sustained basis because there's always people that are going to be moving between jobs. There's always churn in the labor market. Well, we've been below that for a while now, right? So we have a lot of different sort of metrics we can look at, but like I said, there's not necessarily a magic rate, but whatever it is, we know we're pretty close to it right now because we're seeing continued strong job growth, low unemployment, faster wage growth before adjusting for inflation. So that's kind of the labor market picture. Inflation, we can kind of get a little bit more clear about what our target's going to be. But I'm going to pause real quick and see if there are any questions before I get into that. All right. I'm pleased to see that the options actually showed up on the screen for this one. I don't know why a couple of slides earlier weren't working. Just want you to think in terms of your input costs. So I could also ask you about what you charge for your services, and for those of you who are manufacturers or producers, what you charge for your outputs. But just in terms of your non-labor input costs, so not wages, but raw materials, components, services, other input costs. What are they happening? What's happening to them right now compared with what we've seen prevailing over the last couple of years? So I'm going to get into some of the data in a minute. Again, from my perspective, this is looking pretty good right now. A lot of you telling me that things are stabilizing or actually improving in terms of your input cost pressures. That's what we like to see. A few of you telling me things are getting worse right now. I want to talk to you afterwards. Yeah.
They're so high already.
They're so high already, right? So this is an important point somebody made. Now, this is a good time for me to take a quick digression on how the Federal Reserve sort of officially thinks about price stability and our inflation mandate. Because he mentioned that their prices are already high, so yeah, to say that they're not going up any faster is sort of cold comfort if the level is so much higher than it was 2 years ago. When we think about inflation targeting, though, we're really thinking about the rate of inflation. And I know that's not really necessarily good news. We don't necessarily want to cause deflation, though. Happy to talk about why deflation is a bad thing. If anybody wants me to elaborate on that, I can. But for our purposes, so I mentioned that the law says we need to try and support price stability. The way that we interpret that is a 2% average rate of inflation over the long run. There's a particular index of inflation that we target. I can talk more about that if you really want to get geeky about the numbers. I'll show you some data in just a minute here. But that's the way that we think about it. We're not necessarily trying to reverse the inflation that already happened, but just trying to get it stable, under control. Because at any given time, prices for goods and services are always going up and down depending on supply and demand. And we don't necessarily target any particular price. We don't target the price for gas, for example. We target the overall value of the dollar, and the way that we measure that is by looking at prices on average. So this is kind of the consumer price index. Probably most of you are familiar with it. If you weren't familiar with it a couple years ago, you're probably more familiar with it now. Consumer price index is one of the best measures we have of the inflation experienced by families, by households. And this is actually essentially just an average. And again, I'm showing you the year-over-year growth. So you can see, for about 12 years, or for about 10 years prior to the current spike in inflation, we had nice, low, stable inflation. Now, the Fed doesn't actually target CPI as our inflation target. We target a slightly different measure called the Personal Consumption Expenditures Chain-Type Price Index. If anybody wants to know more about what that means, I'm happy to get into it. It's a slightly more nuanced measure of inflation. CPI, for example, only comes from urban areas, so it's not necessarily capturing inflation in rural areas. The CPI is basically a consumer-facing measure of inflation. PCE also covers business costs as well. So there's some advantages to looking at that. It also, the way the index is calculated, tries to make some adjustments for normal behavioral responses to price changes. So, but essentially what they both are average measures of the cost of living. And what do we mean by the cost of living? Well, what they do is they look at a lot of data based on surveys and other data on how people spend their money, how a typical household spends their money. And then they go out and they record the prices of a whole bunch of goods and services. And by they, I mean they're literally people. There's the Bureau of Labor Statistics has a team of just under 500 economists all over the country that they send out to grocery stores and hair salons and all sorts of businesses to record the prices of fixed set of goods. They try and make adjustments for the fact that, maybe the cereal company puts a little less cereal in the box instead of raising the price of cereal, those kind of what they call hedonic effects. And they take all of those things and they summarize them in this index. The important point I want to make is all of these prices, and there's 150,000 different prices they're measuring every month, all of them they're putting into categories based on their importance to a typical family's spending. So a typical family spends about 10% of its household budget on food, so food items get about a 10% weight in the survey. And I'm showing, and so it's a weighted average. And I'm showing you two different measures we sometimes call headline and core. The headline is the overall rate of inflation. Core is stripping out food and energy prices, not because they don't matter. Obviously, we realize those are pretty crucial to most people, but they're a little bit more volatile. So as we've all been seeing recently, gas prices, they go up, they come down. Some of the food and gas prices are more likely to come down than a lot of other prices. And so sometimes you get a clearer signal of where things are heading by stripping those out. It's kind of an academic distinction right now, though, because they're both way too high. And they've been coming down, they've been trending in the right direction, but they're still higher than we want them to be. So we just got our April CPI reading, and that was that came in just under 5% for the headline rate of inflation. A lot of that momentum actually came from declines in gas prices, which is why you see that core rate staying a little bit persistently higher. So a lot of the action has been in energy prices, and you can actually see, let me skip ahead here for just a second, if you look at kind of what are the parts of the index, the components of the index that increase, decrease the most, you can see that a lot of it is concentrated in food, still is driving a lot of the inflation that we're seeing right now. And by the way, I'm not showing you how much they're driving inflation, I'm just showing you how much those individual things change year over year. I'll show you the net impact on inflation in a minute. And you can see that they're, food, electricity, cost of housing is one of the big ones that's increasing. And that, as you can imagine, is a pretty important part of your budget. So that has a pretty high weight in the index. A lot of the inflation that we've seen has been driven by housing. And then we see some things coming down, used cars and trucks, gasoline, obviously, net year over year, big decrease. And again, the level is a different story. We're just talking about the net change. You looked like you had a question a minute ago. Okay. See, if you just let me talk long enough, I'll answer your questions, I promise. But that's not to discourage you from asking questions. Please do. One quick thing that I think, again, since you're mostly on the front end of production in this room, is sort of wholesale prices. One sort of promising headwind I can point to right now, the producer price index, which is a measure of sort of input costs or wholesale price inflation. We saw input prices start to jump before we saw it reflected in consumer inflation. And this has been coming down a lot recently. So that's really headed in the right direction. In fact, if you look at the level that it's at right now, we're looking at at the level that it was prior to the pandemic. Now, we need to see this sustained for a while. This is just 1 month of data, but it's been moving in the right direction. And again, to the extent that wholesale prices are kind of a bellwether and they're going to move before we see consumer prices move, this is a good sign. And again, maybe consistent with what some of you had to say on that survey question. So I showed you this nice happy picture of a near full employment labor market earlier and how we're seeing that manifested in higher wage growth. Once you adjust the wage growth that we've seen for inflation, though, it's a very different story. And this kind of, I'm showing you this for a couple of reasons. So just to show you, this is inflation adjusted year over year wage growth for the same categories of workers I was showing you earlier. Again, you see this is kind of positive growth over the last year, but really, once you adjust for inflation, it's almost no change in real terms, in the actual purchasing power of the earnings. I'm showing you this for a couple of reasons. One, it's obviously one of the really pernicious consequences of inflation, and one reason that we want to keep inflation under control. One reason the Fed is acting so aggressively, or has been acting aggressively over the last year, raising interest rates, trying to get inflation down. But the other thing that's important to point out here is there's this old idea about what causes inflation that's sometimes called the Phillips curve, if you ever took macroeconomics, or the idea of wage push inflation, that there's a trade-off between unemployment and inflation. The labor market gets too hot, the economy is growing too quickly, unemployment gets too low, and that's going to drive up wages, that's going to make it more expensive to produce things, and that's going to lead to higher inflation. There's a lot of reasons to think that that's a good story about what's happening in the labor market. I could go off on a long tangent about what's wrong with that story, but the important point I want you to take away from this chart is that's not really what's driving inflation right now. Because when you look in inflation-adjusted terms, wages aren't keeping up with inflation. They're not leading inflation, they're lagging behind it. So what is causing inflation? Just skip over that one real quick. Well, at least the initial surge of inflation that we're experiencing right now, a lot of it was, I don't need to tell anyone in this room about the supply chain crisis and the disruptions that caused, so I'm not going to elaborate on that. In fact, I'd like to hear you maybe tell me more about how things are going in that direction right now. But one of the other things that was driving the initial surge in inflation that we've been experiencing since early 2021 was a change in how people spend their money. So, we all want to kind of move on from the pandemic and get on with our lives. Unfortunately, we're still experiencing some consequences of this giant shock that hit the economy. And that's something you might expect when you're talking about a shock that large. What I mean by this is kind of illustrated in this chart. So this is just, I'm showing you consumer spending by a few different categories, and I've got it in index terms, so you can just kind of see where it was relative to February 2020. And I'm showing you here, services is the dark blue, durable goods, that's, anyone who's a manufacturer in the room, you're mostly in a durable goods segment, maybe not consumer goods, but so those are big ticket items that last longer than a year. Automobiles, appliances, electronics. And then non-durable goods are going to be things like your pantry items, toiletries, things that last less than a year. Processed food as well, those are all non-durable goods. And what you can see is that like most other categories, these fall off a cliff in the early part of the pandemic, except for non-durable goods. You see spiked a little bit. That was that panic buying wave we all went through. Remember when it was hard to find toilet paper, right? Oh, happy memories, right? And then that fell, right? Because people, so nobody knew what what was going to happen with the economy. And so people started hanging on to their money. And of course, obviously, a lot of people losing their jobs, so they're not spending as much money. And then what happened over time is we saw spending on goods really recover very quickly. In fact, not just recover, but skyrocket, right? And now I want to point out, I have these in index terms. A lot of engineers in the room, so you can kind of think, you're good, quantitatively oriented, and I appreciate that. If you just put these in magnitudes, not in index terms, people actually spend about half of their consumption on services in one form or another. So actually, people spend a lot more on services than they do on goods, typically. If you think about things like traveling, healthcare, obviously a huge one, that's mostly services spending. But a lot of the ways in which we spend our money, going to a hair salon, fall into that services category. And a lot of the ways in which we normally spend our money weren't available to us in late 2020 and into 2021. So people are essentially saving a lot of money because they weren't able to spend it or weren't comfortable spending it in the ways that they usually do. And so that translates to a lot more money left over to remodel your kitchen since you're stuck sitting at home, working from home. Maybe put in a new deck so that you can have friends over and we can all sit outside and hang out, right? So we saw this huge wave in home renovation. That was one of the first things that popped was construction materials. Very early in the pandemic, we saw huge inflation in construction materials prices, right? But overall, goods spending in general skyrocketed. To see this kind of growth, I can't underscore, by the way, if I were to show you this data going back 50 years, you don't see this kind of growth and this kind of volatility in consumer spending. Consumer spending just tends to grow really steadily and slowly over time because people are able to smooth out how they spend money, how they actually, their consumption spending with their savings and with credit, right? It's less volatile than income, right? So it tends to grow slowly over time. So to see more than 30% growth year over year in consumer spending, like you see in this chart, or at least spending on goods, is really, really unusual. And this is actually at the core of a lot of what went on with the supply chain. There were other issues going on with the supply chain that I'm sure you're well aware of, the issues at ports, the issues with trucking and the supply of truckers, but a lot of it was just a traffic jam. People wanted to buy a lot of stuff, a lot of goods, and the supply chain only had so much capacity to deliver it, and that was reflected in an increase in the price of goods relative to so I'm showing you here now, I'm back to prices. I was showing you quantities a minute ago, total spending. Here's the ratio of the price of goods to the price of services. Again, from some of the same data we're looking at here. And you can see this is the long-term trend, pre-pandemic. Goods get cheaper relative to services over time because of technology. It's cheaper to make stuff. You can make more stuff with less people because of technological change. Services require people to deliver usually, and people don't get cheaper over time, right? So the ratio of goods prices to services tends to fall over time, and we saw this reverse during that early period of recovery from the pandemic, and that was reflected in, all that demand was reflected in higher prices, especially for durable goods, those big-ticket household items. Not to mention the wait time and the supply chain effects, right? So that actually drove a lot of the early inflation that we experienced. So now I mentioned earlier that I was going to show you kind of what the net contributors to the measured inflation are, and what you can see is, so this is the overall inflation rate, CPI inflation, like I was showing you earlier. You see that same pattern. This gold portion of these columns here is goods prices, okay? So a lot of the early surge, a lot of the early contributions to inflation were in goods. And then you can see energy is this, sorry if it's hard to see, but this kind of light blue portion of the bars, and then food is the teal portion. Services over here, usually most of the action in inflation is coming from services, partly for the reasons I was just describing. People spend a lot of money on services, demand for services is high. You need people to deliver services. So to see this kind of big growth in goods prices is kind of weird historically speaking. You don't usually see a lot of contributions to inflation from goods prices. On an aggregate, obviously individual things might get more expensive. And then of course we had all these other things happen, like what was happening to commodities prices after the invasion of Ukraine. Some of those things have kind of worked themselves out. And what we've seen happen more recently is faster growth in services prices. Again, to kind of look at a little bit more recent positive news, we're starting to see some disinflation in services prices if you just look at the last few months. That's where a lot of the action has been coming from over the last few months as overall inflation has come down and there's been some kind of disinflation in these categories. We've started to see services take off. And that kind of underscores why, if you sort of Monday morning quarterback the last few years, it might look like the Fed was kind of late to act, because we started to see inflation pop in early 2021. It really took off, right? But there were reasons at that time to think that some of what was going on was a rebound effect from the pandemic. And you can see it if you look at, sorry, I'm going to very quickly go through some between charts here. If you look at services that are heavily affected by the pandemic, and now I'm showing you here the monthly contributions to inflation, so not year-over-year inflation, but what happened over a given month to prices. A lot of, in that early surge, in early 2021, a lot of the contributions to inflation that we were seeing were coming from vehicle-related prices, and this is again a supply chain story. It's that microchip shortage, and things like travel, things like lodging and accommodation, air travel, which were heavily affected by the pandemic. So there was some kind of rebound effect happening. But what happened over time was even as those effects subsided, we started to see inflation become more widespread. So it wasn't just that the rate of inflation was proving more persistent than some people might have expected it to at first, but that it was accelerating, it was getting faster, and it was becoming more widespread. It was spreading throughout the economy and not just in a couple sectors. So that's why what may have seemed like a fairly sudden pivot from the Fed. Because everything that we do is really driven by the data as they come in, and the data started to tell us that this was a more persistent phenomenon than just a rebound from the pandemic. So now I'm going to get into what the Fed's doing about it. I don't need to tell you that we're raising rates. Apologies to anybody who's bought a house recently or had to take on any kind of loan at a higher interest rate. But as I mentioned earlier, that's the way. So the way monetary policy works is through the demand side of the economy. Now, a lot of the inflation that we've been experiencing is supply side. So tightening demand is going to be sort of limited in dealing with that. But to the extent that it's driven by really strong consumer spending, that's where it's going to have its bite. So you can see the federal funds rate. That's our benchmark rate of interest. Happy to elaborate on how exactly this works, but the federal funds rate is basically the overnight lending rate between banks. None of us actually pay the federal funds rate on our credit card or any other loans that we have, but it's a core part of doing business for lenders, and it's a sort of a benchmark by which other rates of interest are measured. And so you can see this tightening. So again, going back to the pandemic, we dropped this down to 0 during the beginning of the pandemic and held it there for a long time. And then we started ramping it up in March of 2021. Actually went by what we call 75 basis point jumps, 3 meetings in a row, basis to 0.75% increase in the Fed funds rate. That's really unusual for us to increase that much at one meeting. And we've been kind of tapering off the rate of increase recently as the data have been coming in. One of the challenges in making monetary policy is the policy that you make today has its effects in the future, right? So it's, there's an immediate response if you look at the financial markets. So you can look at, these are the things that are relevant to us, actual market rates of interest. So here's the 30-year mortgage rate. You'll notice that Treasury rates and the 30-year mortgage rate actually started to increase quite a bit even before the Fed did anything, right? Because of the anticipation effect of monetary policy. So the financial markets adjust right away, but in the real world, where this is actually going to bite in the real world is in changes in, we're making it more expensive to take on a loan to expand a business, to purchase a car, to build a house, to renovate your house, and all those things are going to have the effect of pulling down demand and slowing the economy, and hopefully bringing down the rate of inflation with them, right? But like I said, the challenge is those effects happen over time and they happen in the future. So it's sort of like driving a car with a wonky brake, right? The adjustments that you're making right now, you have to try and get out ahead of the data. I already made a joke about how bad economists are at forecasting. Unfortunately, we're required to do that in order to try and make the best policy available, or the best policy possible. Yes, sir?
Most of this is consumer-based and individual-based.
Mm-hmm.
Do you track anything for business-based, like business capital investment or anything along those lines?
Yeah, absolutely. So those GDP data that I was mentioning earlier, they have you can break out capital expenditures by business. So just to kind of break down some of what we've been seeing recently, big reductions in business what we call non-residential fixed investment. That's the sort of business spending. Big reductions in spending. Generally speaking, that's come down. But where we've seen the biggest reduction is in spending on buildings, on facilities. R&D spending still pretty strong, and sort of capital equipment purchases somewhere in between those two. So still pretty strong growth in R&D, and again, a lot of that is going to be financed out of cash, right? So those things that are more interest sensitive, we're seeing come down more quickly. And again, that's what we'd expect. Yeah. So again, I kind of want to point out, though. I'm gonna leave that aside for the moment. There's a common perception that the Fed's trying to engineer a recession. That essentially what we're trying to do is inflation is too high, so what we need to do is drive the economy into a recession so that we can get inflation under control. That's not our intent. Again, I want you to think about that dual mandate. We don't want employment to fall, right? We have to balance those two targets. The ideal scenario, the best of all world scenario, would be that we see, as I mentioned, we've already seen some reduction in job openings, in the number of job postings, and that most of the adjustment happens kind of through that margin. Inflation gets under control. We can kind of normalize policy and go back to that nice, happy world where we were seeing, positive, stable economic growth. The biggest problem businesses have to worry about is where they're going to find workers, and not necessarily whether the economy is going to fall off a cliff, right? But monetary policy is, it's a machete rather than a scalpel, right? It's a blunt instrument, but it's the tool that we have available to us. So that's those are the sort of the channels through which it works, and it's not an exact science, and that's why we have to be, like I mentioned, kind of really, just sort of constantly paying attention to the data and monitoring conditions as they come in. Again, you'll often see these sort of professional pundits on CNBC sort of say, well, I think the Fed's going to raise interest rates 3 more times before they pause. We don't think in those terms. We're not thinking, oh, we've got to get to X rate of interest, and the argument about is how quickly or slowly to do it. We really have to monitor the data as they come in and be data dependent and see how we're doing relative to those two mandates. So one other quick thing I'll point out. So we have kind of our normal way of doing monetary policy is through interest rates. But during the pandemic, we also printed a bunch of money. We didn't literally print money. That's not how it actually works. But we purchased a lot of assets because, again, just like during the global financial crisis and the period afterwards, there was this risk of being caught in a sort of a deflationary trap in the economy. And we didn't want to end up in that world, so we took a really strong response to the early part of the pandemic, increased the size of our balance sheet, which is essentially printing money. Again, happy to answer questions on how any of this works or kind of the motivations behind it. But one of the things that we started doing at the beginning of last year when we were raising interest rates, we were also normalizing our balance sheet. What does that mean? Well, you can think of the Fed essentially printing money and buying treasuries. We don't, like I said, we don't literally print money, but we credit banks' reserve accounts and buy treasuries from them, increase the size of our balance sheet. That's not something we normally have to do to make monetary policy. Usually we can just kind of trade one for the other, but actually increasing the size, what they sometimes call quantitative easing. And you can see that this continued throughout the period following the pandemic. What we've been doing since then is drawing down our balance sheet, letting the securities that we own expire and roll off our balance sheet. And that's another way of reducing accommodation or tightening monetary policy. This little spike that you see right here is the response to the SVB thing. That was, but you can see the trend in that direction, and we've resumed that sort of balance sheet normalization after backstopping those accounts to make sure that people didn't lose their money. Again, happy to answer questions about all of that. The good news I can leave you with is, once again, if you look at forward-looking measures of expectations, of inflation expectations, so I mentioned right now, going back over the last year, inflation is still about 5% over the last year, give or take, depending on which measure you look at. Going forward, and I'm showing you this over a few different windows, there are these sort of market-based measures of expectations. So, for example, you can look at the difference between the market rate on Treasury securities that are inflation protected or TIPS versus those that are not, and kind of look at that's the sort of market's best guess of inflation over a 5 or 10 year window. And again, depending on whether you're going 2, 5, or 10 years, these are staying relatively anchored right around just above where we want them to be, right around 2%, right? So financial markets are betting that we're gonna get this done. We're gonna get inflation back to an acceptable level, and we're being aggressive in raising interest rates because we want to maintain our credibility and we want people to know that we really mean it. And the good news is, the markets are at least guessing that we're going to do that. We're going to get that right. So that's kind of that's sort of the sort of overall economic outlook. Again, I'm not going to give you a prediction of whether or not we're going to go into a recession or how deep it's going to be, but that's the context. We need to see inflation get down further, is the bottom line there. And now I kind of want to get into, before I wrap up here, I do want to just kind of maybe ask a little bit about your outlook. What do you expect to happen to inflation? Of course, these options aren't going to show up for me, so I'm going to skip ahead to the next one.
Technology.
That one's not doing it either. What the heck? Why is it some of these work and some of them don't? All right. This one's, okay, this is the more important one. What do you expect to happen at your business for the rest of the year? And I'm asking you qualitatively, I'm not asking you X% growth in sales. I just want you to think kind of overall, what's your outlook through the end of the year? Are you optimistic? Are you pessimistic? Are you neutral? Do you feel differently now having heard my talk than you did at the beginning? Because that I'd be really curious about. Again, it looks like most of you, the vast majority of you, are coming in that kind of somewhat to very optimistic range, which is nice to see. I think I have maybe a couple minutes left, so I'm going to see one more time if we have any questions before I go ahead and shut up and give you the rest of your day back. Got one in the back of the room there. And I can just repeat his question. And
So on back to your slide about how much money was printed.
Yeah.
So your line was flat from 2007 over. Was there ever another period in history where we printed that much money in that short of a time?
Not really, no. So yeah. So here's the global financial crisis. And if I showed you this, I mean, I could show you these data going back years, right? Our balance sheet hovered around $800 billion for decades, right? Again, because the way we normally do policy is we buy and sell the stock of securities that we have. That's the way things used to work. Then during the financial crisis, we dropped interest rates down as far as they could go, and the economy was still in free fall. And that's how come what they called, we never used the term quantitative easing, by the way, that was a financial press's term. We use the term large-scale asset purchases because that's a much more direct, I mean, we're literally printing money and buying stuff is what we're doing, right? Now, here's the thing. Ordinarily, if you go by this sort of classic, what they call quantity theory of money, this should have led to really high inflation, right? And we didn't see it. We didn't see it for this whole period. And that's why they kept successively, because the recovery was persistently weak, the labor market was persistently weak, and so they went through these rounds of, again, what the financial press called QE2 and QE3. Remember that? That's what these are right here, where they basically said, we're still not seeing inflation. By the way, quick digression here. We have a 2% rate of inflation that we target over time. We actually declared that right around 2010 after the worst part of the financial crisis was over. And then we were persistently below that target for a long period of time. And we viewed that as a problem because everything that we do is reputation-based. And so if we say we're going to do something and we don't do it, that damages our reputation, right? So that's really at the core of why, again, these rounds of what the press called quantitative easing was going on. You can see starting in 2017, once we really got more toward a full employment labor market, we started this process of balance sheet normalization. And then the pandemic happens, right? Now, we're now in an environment where we printed up all this money and we do have high inflation. That's what you'd expect to see. And I'm not trying to be coy about the fact that this policy was probably inflationary, right? There's a lot of other things going on. And again, if one for one, we probably should have been experiencing higher inflation, but there were other things going on that were sort of suppressing the rate of inflation during this period. And the other thing going on during this period, again, I'm not trying to be cute about it, you might remember the government mailed checks out to people, right? That's part of what was going on behind that surge in consumer spending too. It's also, by the way, reflected in a much higher rate of savings. A lot of that money that a lot of those checks got put in savings accounts. We have really higher savings rates. So there's a lot going on, right? But yeah, ordinarily, classical monetary theory tells you central bank prints a bunch of money, that's going to cause inflation. We're not stupid. We know that's the risk. The balance of considerations in March and April of 2020 was there was a bigger risk from doing too little rather than doing too much. That was sort of the choice that they made. Now we're sort of dealing with the consequences of it. Yeah.
What's the 2 to 3 year goal for this graph?
So I wouldn't say that there's a goal. We're not necessarily ever trying to get back to here, right? Because again, everything I can't underscore enough, everything we're doing is determined by inflation and unemployment, right? So if we get back to an acceptable rate of inflation, a strong labor market, there's not necessarily a reason. We're probably going to continue tapering off and rolling off this extraordinary amount of assets that we own. But there's not necessarily a goal. We're not trying to get to a particular level. It's just that this needs to move in the same direction. It needs to be complementary with the interest rate policy. So we're raising interest rates, and we're also reducing the size of our balance sheet. Those two things need to row. They need to be rowing in the same direction. Where the end goal is not necessarily, that's not like a first order consideration. Yes, sir.
Talk about assets that you own. What exactly do you own?
Good question. Mostly treasuries. So the Fed, basically we buy U.S. Treasury securities, so U.S. government debt, and then what we call agency mortgage-backed securities. So those are Fannie and Freddie issued mortgage-backed securities. You can think of that going back to the financial crisis as being kind of a backstop to the housing market. Now, Fannie and Freddie, the reason we call them agency, those are owned by the Treasury Department. They were taken over by the Treasury Department during the global financial crisis. So those are essentially just another kind of government debt. So that's the vast majority of the assets that we hold. And beyond that, there's a small amount of what we call repo. So we basically will take loans or other assets off of banks' balance sheets and provide them with money temporarily and swap it back eventually. But that's a really small portion of this overall balance sheet.
We got time for maybe one more question.
Yep.
So understanding that you're separate from the government, what, if any, impact on price stability and maximum employment do you foresee with the looming debt crisis, the debt ceiling issue?
Oh, the debt ceiling. I guess the short answer to that question is the sort of the first order consequences of a default on U.S. debt. They would be more on the unemployment side. But really, what you're worried about more with that is a financial crisis, an international financial crisis. And I can't really underscore this enough. And by the way, I want to remind you that I'm speaking for myself and not the Federal Reserve. But I say this, but I say that in a way of saying this is. I'm not going to call it a consensus, but I would say very widely agreed upon belief that U.S. Treasuries are the closest thing to a risk-free asset in the world. They are the benchmark on which the entire international financial system does its business, right? Why is that? Because the United States has never defaulted on its debt in 240 years. And again, I'm going to go back to Alexander Hamilton. That was really at the core of the assumption of states' debts. The creation of the first Bank of the United States was all about making sure the United States got off on good financial footing and had good credit. Because of that, we can borrow cheaper than any other country in the world. And there's tremendous demand for U.S. Treasuries, again, because it's the safest place to park your money, right? So what happens if the international economy's confidence in the willingness, and it is, I should point out, willingness, not ability, of the U.S. government, the U.S. Treasury, to continue servicing that debt is shaken, right? Now all of a sudden you're going to bake a huge risk premium into that. It's hard to think about what the actual consequences of that shock would be, right? So that's really what's at stake in those debates, right? And that's why I think fundamentally, it's sort of this game of brinksmanship, and at least that it's not actually going to happen, right? Because you're playing with a loaded gun, and by a loaded gun I mean a gun that's loaded with nuclear warheads, right? It's that significant, right? So in terms of if the U.S. were to go into partial default on its debt and it triggers a global financial crisis, would probably be disinflationary. That's not a good way to get low inflation, though. I think we would all agree upon that, right? Again, I'm speaking for myself and not the Federal Reserve, and importantly, I'm weighing in on fiscal policy here. We're in charge of monetary policy, And again, I think that this is in some ways not really controversial, right? To say that like the full faith and credit of the United States is a tremendous asset to our country. It's tremendous importance. And so let's all hope that that those negotiations get worked out one way or another.
All right, Joe, did you have any closing thoughts?
No, thanks for asking that question. No, I really do appreciate you being here. I'm sorry that some of my slides didn't work. Still got a lot of good content from you, and you have my contact info up here. Please do connect with me. I'd love to would love to hear more about how things are going for you, and if you have other events that you're looking for a speaker for, or actually I love taking part in small roundtables and talking about business conditions. Would love to connect with you. So thanks a lot for having me out, and I really do appreciate it.
Let's give Joe a hand.